I'm Ryan Dupuy. I'm a financial planner at Freedom Financial Planning. We get a lot of questions about cryptocurrency at the moment, as most people can imagine. It's not for everybody. It gives you the chance to get lots of strong gains quickly, but it also is very risky and very volatile. So one of the biggest issues with cryptocurrencies is the lack of regulation. So if you trade shares on the stock market, it's regulated by the ASX, the Australian Securities Exchange, and ASIC, the Australian Security and Investment Commission, to make sure that the companies are doing the right thing and disclosing all relevant information. With cryptocurrencies, they're not subject to that, so the market is free from manipulation, and that a lot with initial coin offers that are a little bit misleading, pump and dump stock strategies where people talk up the price of a Bitcoin because they hold some, they sell it at the high point and make a bunch of profit at the expense of everybody else. So look, cryptocurrency is an investment. You can make a lot of money. Just be aware of what you're doing when you invest into it. Do your research. Use a secure wallet because you don't transact on the ASX. You've got to go through third-party wallets. So just make sure you know what you're doing before you jump in. So a lot of people don't understand it because they think if they earn $120,000 a year, they're going to be okay. They're going to have plenty of money. But the biggest issue that we see with people is you live to your lifestyle. So the more you earn, the more you tend to spend. And you may not realize it and you might not think of it. When you're earning $50,000 a year, you think if I earned 100, I'd have plenty of money. Except when you start to earn 100, you want bigger cars, you want better places, you go out for more holidays and restaurants. And so you nickel and dime yourself to death with a lot of small purchases that just become more expensive over time. That's probably the number one issue with it. But also a lot of people don't budget. So they don't have any idea about how they spend or where their money goes. And so one of the best things you can do, no matter how much money you earn, is do a budget. And it doesn't have to be a really prescriptive thing where you've got it down to every penny, but understanding what's coming in, where it's going, is gonna set you up to, no matter your income level, to actually be able to spend and take full value of your money. The other thing is people don't pay themselves first. So when they do a budget, they list all their bills and think, I'll pay myself with what's left over, but there probably isn't anything left over. But if you put the first item on your budget is pay yourself, say 5 or 10% of your net pay, put it into your home loan, put it into a savings account, and then work out the rest of your bills, that's going to make you more successful than any other budgeting tip. 10 grand is a good amount of money, so congratulations, you've got something that you can actually start with, which is great. The best investment is a managed fund or an ETF or an exchange traded fund. What they are is an investment company that buys and sells shares on your behalf. So by buying into an ETF or a managed fund, you're getting exposure to 50 to 100 different companies with an investment professional doing the daily decisions about buying and selling individual stocks and doing market research. So you can focus on just letting the money grow over time. It's a fantastic way to dip your foot in and get used to the ups and downs of the market. For beginners, we would usually recommend an ETF over individual stocks. What you get is broad diversification. So with an exchange traded fund, it's an investment that buys and sells stocks. So you'll end up with a portfolio through the ETF of between about 50 to 100 different companies. And you don't have to worry too much about the buying and selling of the underlying stocks. You just manage that one investment. Whereas if you're trying to buy a portfolio yourself, you carry individual company risk because one company may not perform great, as opposed to a portfolio of 50. If one company doesn't perform well, the other 49 are going to balance it out. So it's a much more stable investment, particularly for a beginner investor. So we would always recommend that people invest on a regular basis, so monthly basis is great. There's a concept called dollar cost averaging, which is what you're doing. So by putting in a regular amount every month, you're smoothing out the price of your investments because some months the price is going to be up, some months it's going to be down, and then over the course of a year, you're going to end up with a more average unit price as opposed to trying to sit on the sidelines and choose a dip because when is the dip? Is that the low point? Is tomorrow going to be lower? Is it going to go up tomorrow and I've missed the dip? So by having a regular structured investment, you don't have to worry about that. You're just investing for the long term. And remember, time in the market will make you more money than trying to time the market.